Yeah, I think there's certainly an interest in the European distressed market, and from some parts of the world that's changed somewhat markedly in the last 6 to 9 months. And I think probably 9 months ago it was very difficult, for example, to talk to US investors about European distress because there was still a big question mark as far as they were concerned over the survival of the whole European project. I'm not saying that that's gone away, but I think there is a sense that, anecdotally it hasn't fallen apart yet, so maybe it won't. There is. I mean, I think and people have alluded to this. I mean, the big issue with talking to investors about the distressed or opportunistic opportunity in Europe is that it's difficult to sit in front of an investor with a product and not put on the front of the cover a 20% return. I mean, if you're not there with a 20% return, you're not really a distressed investor. And yet, at the same time, I think it's been mentioned earlier on. Go and talk to a bank and tell them that your capital is 20% capital, and they'll tell you that that's not of interest to them. I mean, the bid-ask spread is just too far away, and that's the key at the moment to unlocking the situation. Having said that, what we're finding is clearly not in terms of buying non-performing loans, but in terms of the way that the banks, the pressure on the banks is driving through some repricing in the markets of assets themselves. I mean, it's more where banks have sub-performing loans where they can, as senior lenders, get most of or all of their money back by selling the asset. We are finding that in the secondary market there are some opportunities to buy assets for some of our clients, but they're not clients with 20% return hurdles. So there are some interesting opportunities out there, and I think that pricing sort of is getting to the stage where sometimes the downside scenario is pretty compelling. I mean, very, very difficult to see yourself losing money, but at the same time, in the absence of some sort of growth scenario, it's difficult to see where you really make lots and lots of money to try and make 20%. I mean, our focus in trying to get higher returns, the sorts of returns that opportunistic investors would normally like, is to try to get involved in restructuring situations with banks, because normally within that restructuring you would get some kind of stapled debt, and that stapled debt allows you to get leveraged returns which aren't available elsewhere. That's clearly something that you're really picking over the bones of the market at the moment to find those things, and we've given up waiting for the avalanche of opportunities to come, but we do think for a limited amount of capital there will be opportunities over the next 3 to 4 years. Particularly, and again, I can't remember who alluded to this earlier, there's a lot of focus on banks and their non-performing loans, but there's a big situation out there where banks have performing loans which they're going to have to do something with to stop them becoming non-performing, and therefore have a very, very large, have to put a large amount of capital against them. And those issues are normally real estate issues. And as a real estate investment management firm, we think we can add something there. So you've got to put some capital in to keep the cash flow running, because if the cash flow doesn't keep running, the loan doesn't stay current, and therefore it becomes non-performing. I mean, we think at that level there are quite a few opportunities. Before the whole thing gets to the kind of situation that you were talking about, where everybody's the whole thing's blown up and it's being worked out.